Have you ever wondered how options trading works? Well, let's unravel this financial jigsaw together. Options are financial derivatives, kind of like contracts, that provide investors a right, but not an obligation, to buy or sell an underlying asset at a predetermined price before or on a specific date known as the option's expiration date. There are two types of options: call options and put options. A call option gives the holder the right to buy the underlying asset at a specified price, often called the strike price, before or at the expiration date. Investors typically buy call options when they believe the price of the asset will rise. On the other hand, a put option gives the holder the right to sell the underlying asset at the strike price before or at the expiration date. Investors usually buy put options when they anticipate the price of the asset will fall. Now that we have an understanding of what options are, let's delve deeper into the mechanics of options trading. First, let's talk about call options. A call option is a financial contract that gives you the right but not the obligation to buy a certain asset at a predetermined price. This predetermined price is known as the strike price. The beauty of a call option is that you can exercise this right at any time before or on the option's expiration date. Now you might be wondering, why would anyone want to buy a call option? Well, investors typically purchase call options when they have a hunch that the price of the underlying asset will rise in the future. By doing so, they can buy the asset at a lower price and potentially sell it for a profit. For this right, the buyer pays a premium to the seller, or writer, of the call option. So in essence, a call option is a bet on the price of an asset increasing. Now let's move on to put options. A put option is another type of financial derivative. It grants the holder the right, but not the obligation, to sell an underlying asset at a predetermined price, known as the strike price. This can be done anytime before or at the option's expiration date. The buyer of a put option pays a specified fee or premium to the seller. This premium is the cost of obtaining the right to sell the underlying asset. Now you might be wondering, why would someone buy a put option? Well, investors typically purchase put options when they anticipate the price of the underlying asset will drop. By owning a put option, they can sell the asset at the strike price, even if its market price has fallen significantly. In this way, they can limit their potential losses. Therefore, a put option is essentially a bet on the price of an asset falling. There are a few key concepts in options trading that are crucial to understand. First up, we have the strike price. This is the predetermined price at which an option holder can buy or sell the underlying asset. It's the price tag for your right to trade. Next is the expiration date. Remember, options are like Cinderella's magical carriage. They are time-sensitive and often lose value as the clock ticks closer to midnight, or in our case, the expiration date. Then, we have the premium. This is the price you pay for the rights granted by the option. Think of it as your ticket to the options trading ball. Lastly, let's talk about being in the money, at the money, and out of the money. An option is in the money if it would turn a profit if exercised immediately. At the money options have a strike price that's around the current market price of the underlying asset. Out of the money options, on the other hand, wouldn't be profitable if exercised right away. These terms are fundamental to understanding and navigating the world of options trading. Options trading isn't just about buying and selling. There are various strategies and risks involved. For instance, let's take a look at a diagram of a covered call strategy. This strategy involves owning the underlying asset and selling call options on it, providing additional income from the next. We have the protective put strategy, which is illustrated in this diagram. It involves buying a put option to safeguard against a potential decline in the value of the underlying asset. Then there's the straddle. To better understand this, let's examine the straddle strategy diagram. The straddle involves buying both a call and put option with the same strike price and expiration date. This strategy is used when an investor expects a significant price movement but is unsure of the direction. Spread strategies like the bull call spread or bear put spread involve using combinations of call and put options to create specific risk-reward profiles. But remember, options trading comes with its own set of risks. You could potentially lose the entire premium for the option. Options trading is a powerful tool when used correctly, but it's crucial to understand the risks and mechanics before diving in.